Hello, good afternoon and welcome to another review of the Week in Markets. I'm joined by Paul Durrans from our investments team. Today we're going to discuss the economic data we've seen through the week. Now, it's been a very UK-focused week, which is a great topic for today. We're going to begin with the UK employment data, Paul. My read would be not much change for the Bank of England, but there's probably some interesting facts within the data that you can bring out for us.
Yeah, absolutely. So we started the week with UK employment data. We saw unemployment rate tick marginally higher from 3.8% to 3.9%. So still pretty low.
Yeah, very.
But a little bit of softness creeping in. If we look at private sector employment, it's still got 300,000 less workers than before COVID. When we look at wage growth data, we're seeing some moderation. So looking at wages, including bonuses, that moderated from 5.8% down to 5.6%. Excluding bonuses, again, a slight moderation from 6.2 to 6.1%. That's important because, it feeds into the inflation environment. And if the Bank of England's going to get inflation to 2% sustainably, they need wage growth to moderate. And so it's pleasing that that's come through. But in general, a little bit of softness creeping in, but not severe.
Yeah, and I suppose the challenge for the Bank of England is they can be looking at the private sector data and they are seeing the softness there, particularly in the wages, but it's the aggregate number, the overall economy they have to focus in on, and that's nowhere near yet being close to 2%. So I guess if we let's draw on the idea of private sector weakness for a little bit more. Do we think that in any way feeds into the GDP print we saw?
Yes, exactly. There's, I suppose, the challenge for the UK is there's a lot of people on long-term sickness. And if we look at the GDP data that was released this week, it was a slight improvement from the fourth quarter, but we've got to remember we've come from a technical recession, so negative growth, and we had very, very, very modest growth in January over 0.2%.
And of course, January is usually always a positive month because of the New Year sales, retail spending. People want to get some bargains in the January sales, so we probably should have expected a positive print. The markets did, but it wasn't really anything to shout about, was it?
Absolutely not. If we think about the growth that the UK's delivering compared to, say, somewhere like the US, stark contrast.
And of course, we've just had one of the wettest Februaries on record, and that may actually impact retail sales ahead, so we'll find out next month, of course. So all in all, the UK economy ticking along, no real acceleration in GDP growth. The quarterly numbers, the analysed numbers for GDP still negative, so there's still that very weak structural impulse within the growth picture. Let's go to somewhere where there is a stronger growth picture, the US. Now, we've had inflation data from there, middle of the week. Could you update us on that?
Yeah, so I think for context, if we think where the US inflation where it peaked last year, over 9%, it's down, it's been coming down due to base effects through energy and goods prices. Now we're getting to a level of, before the report at 3.1% for CPI year on year, it edged up to 3.2%, so slightly higher. And the month-on-month prints were slightly higher as well, so higher than expected. And if we look at core inflation, so stripping out volatile components of energy and food, that also came in a little bit higher than expected. So a bit of inflationary pressure still in the system, and it has been well flagged by economists, by our own discussions on the team, that getting inflation down to that 2%, that final leg, is a bit more challenging, and that's certainly proved to be the case.
And I guess it's going to be the hardest in the US because it is the strongest economy. You know, they've got the fiscal impulse. The employment growth is much stronger than we are experiencing here in the UK and Europe. The Fed, no doubt, will reflect on that next week when they update. Let's think about just the market reaction that we've seen, because it is noticeable that despite these surprises, bond yields are a bit higher, but equities are performing well. What do we think? Just focusing on equities, what do we think the equity story is telling us, really?
I think what it's telling us, the Federal Reserve in December flagged that they've reached peak interest rates, so they're no longer going higher, expecting them therefore to go lower. So they've taken comfort with that, and they're taking comfort that inflation, whilst it's not at 2%, it's around 3%, which is, it's heading in the right direction, albeit a little bumpy. but it's the growth backdrop for equities that they're really focusing on. Growth is extraordinarily strong. The fiscal impulse, as you said, employment remains strong. And so companies can benefit as long as consumers continue to spend and grow their earnings. And stronger earnings growth is great for stock prices.
And of course, for as long as we see this growth in the numbers, the market can be quite comfortable expecting fewer and fewer interest rate cuts.
Yeah.
So it's not necessarily a bad thing for corporates when they are saying earnings expectations go up. We've already come from a fairly strong background, profitability is good, aggregate employment is very, very high, and there's still that demand for workers there, so that is constructive. So I guess, in summary, Paul, if I was to reflect on this, the UK, no real change, it's still trundling along. It's going to be difficult to see a renewed GDP impulse, see a renewed growth impulse because private sector job growth remains quite weak. Yeah. The CPI data in the US reflects an economy which is humming along above trend. Might be some concerns if this slight tick up was to continue, but that's probably a debate for the Fed to have later in the year.
Yeah.
But all in all, rate cuts probably still on the horizon, but just fewer than we were anticipating at the start of the year.
Absolutely.
Great, thank you. Well, that's all for today. So it's been a constructive week for equities. Bond yields reflecting a global economy which is inflecting higher. We're seeing revisions to growth expectations, and equities are taking that quite well. So please do like and subscribe both this and the podcast, which will be published later on as well. Thank you for joining us, and we look forward to speaking with you next week. Thank you.